Hello guys, it's James from FXAX here and welcome to the FXAX YouTube channel where we cover everything trading. We provide transparent, informative Forex content without the BS. I want to welcome you all here today to the first of many videos where we show you trading strategies that you can use in the Forex or crypto markets. Before we begin, a disclaimer for you. Forex trading carries a high level of risk to your capital, and you should only trade with money you can afford to lose. And remember, the content we produce is for educational purposes only. We are not teaching these strategies so you can take these and go trade them on live markets right away. The purpose of these strategy videos is to show you all how different indicators can be used in Confluence, and to help each of you understand some of the different trading styles and methods. We hope many of you will find success practicing these strategies on demo accounts or incorporating parts of these into your own strategies. We have also marked timestamps on the video to help you guys navigate to different parts if you so please. However, we do advise you to watch the entirety of this video. If you do enjoy the content, please do like, comment and subscribe. It'll help us provide the content you genuinely want and help us with those YouTube algorithms. Alright guys, as this is our first strategy video in this playlist, we really wanted to come out of the gate swinging on this one and show you guys a really solid strategy that can be used on any chart, on any time frame, on any asset class. If it has a chart, you can trade it. Though this strategy will work best on the 15-minute chart and higher. This strategy is one of our favorites as this can be used for day trading or swing trading. What makes this strategy so strong is that it is a trend continuation strategy, entering in on pullbacks, meaning we are going with the flow here, trading in the direction, using the strength of the overall trend to our advantage, not trading against the trend. There are many counter-trend trading strategies as well, but in this strategy, we are swimming with the current, not against it. This strategy is one that we really recommend practicing for new traders before using it, as it combines multiple tools and techniques that could be considered a little more intermediate or advanced that should be understood and practiced thoroughly before diving in. What makes this strategy so powerful is Confluence and combining areas of the chart that many traders are looking at, really highlighting strong areas where there is likely to be strong trading activity and volume. It is good to keep in mind when trading that many chart patterns and technical analysis patterns play out simply because that is what all the traders and institutions watching those patterns are expecting to happen. For example, if there are thousands of traders and institutions all looking at a pattern like this, expecting the price to hold at the support level, chances are they're all going to buy at this level, causing the price to go up. So, in a way, it is a self-fulfilling prophecy, as it was the buying at that level that they predicted that caused the price to go up, causing their prediction to play out. Support and resistance levels are the main levels traders look at for basing their trading decisions and biases. We will cover these levels a little more in depth in another video and show you guys how to find the strongest levels. But for this strategy video, I just wanted to cover that these levels and areas are important, as these are the areas where many traders are looking to place their trades. While many traders look to use these support and resistance levels, many other traders prefer to use moving averages. Moving averages are often referred to as the lazy trader's support and resistance levels, and they can be really useful in determining key areas. Many institutional traders base their trading activity around areas highlighted by moving averages. Different moving averages have different uses. We will also be doing a more detailed video about different lengths and types of moving averages, but for this video, we are going to be focusing on the 20, 50, and 200 exponential moving averages. The reason we chose the 20, 50, and 200 is to be able to catch trend continuation trades off different levels of strength of a trend. Very strong trends tend to use the 20 EMA as an area of support. The 50 EMA tends to be used as an area of support for mid to longer term trends, while the 200 EMA tends to support longer trends that can play out over a longer period of time. It is good to be aware of each of these levels as there are many traders and institutions who watch these levels to base trading decisions from. The third and final area for this strategy we are going to cover are Fibonacci levels. As with support and resistance and the exponential moving averages, What Fibonacci levels actually are and why they are used are outside the scope of this video. All you need to know is that it is a very powerful trading tool that can also be used to mark key areas on a chart. We will cover Fibonacci tools, uses, and strategies more in depth in future videos. If you are not familiar with Fibonacci levels and you want to learn more before we release future videos on the topic, there are many resources online that can teach you everything you need to know to perfect the use of it. The reason Fibonacci levels work so well with this strategy is that Fibonacci levels are another area that many traders are watching. Traders watch for the golden ratio area. The golden ratio is expressed in three percentages: 38.2%, 50%, and 61.8%. You don't need to know about what those percentages are, just be aware of the area and know there is often strong trading activity at these levels. Charting platforms like TradingView or your MT4 or MT5 terminal already have built-in Fibonacci tools set up with these levels marked out, so traders can easily just plug and play. They are already set up by default and can be used right away. Now, how do we use all these levels and what makes this such a powerful strategy? As mentioned, the key to this strategy is combining these areas that many different traders and institutions are watching. Say that for a given day, there are 1,000 traders looking at a support level, there are 500 traders watching the Fibonacci levels, and a different 500 traders looking to use the exponential moving averages. By combining the three, you now have the support and agreement of 2,000 traders all looking at the same area as you. The more traders looking to place the same trade as you, the more strength there will be behind the movement. This is a good time to bring up our FXAX tip of the day. When looking for a chart to trade, you won't be a successful trader trying to force trades on messy charts. You need to be patient and let the right setups and trades come to you. It's like trying to feed a bird by hand. You're never going to be successful chasing around and trying to force the bird to eat from your hand. You need to be patient, sit back, and let the bird come to you. Trading is the same way. We do not control the markets are going to do what they are going to do. As traders, it is our job to adapt to and recognize the ebb and flow of the charts and work with the information the chart is giving us. Strategies like this one only work when the market conditions line up to fit the setup. A trend continuation strategy like this one isn't going to work on a chart that looks like this. In fact, most strategies won't work on a chart that looks like this. This area is what traders refer to as consolidation, or chop. There is no clear direction. Traders cannot make heads or tails if the market wants to go up or down. So placing buys or sells here really is a gamble. Areas like this are where most traders end up taking most of their losses. When looking for trend continuation trades, using the exponential moving averages is a great way to ensure you are not trying to trade choppy, directionless markets, and they can help you more easily identify if the market is trending in a certain direction, and can identify the strength of a trend, giving you confidence in the direction of your trades. Look for a nice fanning out of the EMAs that show a strong directional trend. Charts like this are trend traders' bread and butter. Okay, so let's put this all together and highlight how these areas can be used together to really nail some big home run trades for massive profits and winning trades. Here are a couple of chart setups examples where you can see how these three areas of Confluence came together for some big wins. These examples show how these three areas lined up perfectly, the type of trades that trend-following traders dream about. We can see price fired up in a direction, then retrace perfectly into a support level we were able to previously identify, then rejected off that support level that also happens to line up perfectly within the Fibonacci golden ratio at the 50% Fibonacci retracement line. And for the third confidence check, the price was also supported by rejecting off the 20 EMA. Keep in mind that we are calling these areas of confluence. The price will likely not always match up to these exact levels on all three lines on the chart. So it is best to think of support and resistance areas and not just hard lines that price is expected to touch exactly. These are three different tools and methods that traders are using to identify very strong levels to place their trades. And we were able to take advantage of combining all three of them. We really increased the win rate percentage of our trades. From this example, you can see the trades would have really paid off. I know many of you may be thinking that these examples are cherry-picked and are too perfect, and that trades like this are very rare. But that isn't true. With so many different trading pairs and charts, and being able to use this strategy on any Forex pair, any crypto pair, stock charts, futures markets, etc., there are always opportunities exactly like these to be able to place profitable trades. You can find trade setups like these every day. So, your job with this strategy and what you are going to do is wait for a strong trend to take off, identify the direction of that trend, then you are going to wait for a pullback into a strong level that you identified by marking out your support or resistance area, your moving averages, and your Fibonacci retracement levels. Then, as soon as you see price reject off that area, you enter your trade and ride the trend continuation, really taking advantage of the strength of the move that has already been put in motion. Like a surfer catching a wave, the market is going to be going in that direction with or without you. You may as well jump on and catch the ride. Be patient here and don't just FOMO into the trend as it is already flying. It is best to wait for the price to pull back into an area that you already marked out as your area of confluence. The chances of the price hitting these levels, being rejected off of them, and continuing on in the direction of the trend is very high. Trades like these can boast some of the biggest returns traders can earn. Remember to always keep an eye on major news events before opening your trade, as news events can cause such massive volatility spikes in the market that these trade setups can get blown right past, or your winning trade that is nearing your profit level can spike dramatically and hit your stop loss instead, even though the trade looked like it was set up perfectly. Another great thing about this strategy is that you can also combine any of your favorite candlestick patterns, price action patterns, divergence patterns, overbought or oversold levels, or other indicators that will only strengthen this strategy and increase your win rate. As far as the take profit and stop loss levels for this strategy, you can use your own preferred money management style. If you prefer scaling in, scaling out, using trailing stops, or as we are using the Fibonacci tool for this strategy, you can also target the Fibonacci extension levels for your take profit levels. If you don't already have a money management plan in place, we will be covering determining these levels and techniques more in another video. But for this strategy, you can use this method. I usually find a good 2-to-1 risk to reward ratio works out well. Placing the stop loss just below the Fibonacci golden ratio or just beyond the level of support or resistance works well. Then placing your take profit at 2 times the risk. But that is ultimately up to you and your risk tolerance as a trader. An example of how that would look can be seen here. That brings us to the end of this video. I hope you guys found it enjoyable and get the chance to go practice this strategy. Try on different Forex pairs and crypto markets. Try incorporating your own indicators with it. Test out different take profit levels and strategies, and of course backtest this, and demo trade it before ever using it on live markets with real capital. Thank you for watching and stay tuned for future content, where we cover more trading strategies that can really increase your trading success. Please visit www.fxax.com and join our completely free Telegram channel. All socials can be found in the description below. Thanks for watching the video. We really hope it's been useful. Stay tuned for more content.